bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the January 16th, 2024 podcast. This is a breaking news podcast. Affordable rental housing developers, investors, property managers, underwriters, and many more will want to pay particular attention to this episode. Last Wednesday, January 10th, the U.S. Department of Housing and Urban Development published a notice in the Federal Register that sets forth some details as to how they will calculate income limits for 2024 for low-income housing tax credit properties, as well as multiple HUD programs, including Section 8. Now, as many listeners know, HUD income limits establish the maximum income families can generate and still qualify for tax credits, subsidized rental housing. Now, HUD income limits also establish the maximum rents that owners of tax credit properties can charge their tenants. Now, in the notice, HUD said that the income limits for 2024 will be calculated under a formula that limits the maximum possible increase in median income in any given area to a ceiling of 10% year over year. Now, derivatively, this means the rent increases in any area would similarly be no more than 10%. And I should say the maximum rents, the increases in the maximum rents in an area would not be more than 10%, as there are many properties where owners currently aren't charging maximum rents. Now, absent this 10% cap, under the approach used last year to calculate income limits, the maximum increase this year would have been 14.78%. So it basically means that rather than going into this year thinking the maximum cap might be 14.78%, if it was done the same as last year, it will now be no more than 10%. Now, as our viewers on YouTube can see, I've invited Thomas Stagg to be my guest. Thomas is one of the nation's leading experts on rent and income limits. And as I said before, I think outside of HUD, Thomas is the nation's leading expert on rent and income limits. Now, in today's episode, we're going to discuss the mechanics as to how the cap on annual increases in median income has historically been calculated. We'll discuss what HUD clarified in the notice as to how income limits will be calculated in 2024. Let me take a moment to congratulate HUD and thank them for issuing the notice and stating how these calculations would be made, because it really helps developers and operators of affordable housing know what to expect with respect to the income limits, which we do expect to be released April 1st. But getting back to what we're going to talk about in the podcast, we're also going to review some of the implications of this notice on existing rental housing, as well as housing that is in a developer's pipeline. And finally, we will look at some upcoming key dates that you'll want to be aware of as the income limits start to be rolled out. Now, that is a lot to cover. So if you're ready, let's get started. So Thomas, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's good to be back. Good to be with you.
It's always good to have you. You're a very popular guest on the podcast, and I appreciate you making time for this breaking news item. But before we start talking about that, I did want you to describe for our listeners some of the services you provide to clients of Novogradac.
Yeah, thanks, Mike. I work mainly with our developer clients that are doing affordable housing. And so I assist with annual audit and tax work, final cost certifications, and all that fun attest stuff. But I also assist clients who are trying to figure out, does this project even make sense? Is it feasible? So doing projections, underwriting assistance, and helping with applications in various states. And on top of that, I'm kind of the HUD guru in the firm, HUD data guru in the firm. I should say there's people who are more HUD audit gurus than me. And so I end up updating our rent income limit calculator and managing that process. I prepare our income limit estimates, which estimate future income limits based on the underlying data that HUD's going to use. And so I do a little bit of everything. If you're a developer or investor, we should know each other and we should be figuring out how to do more housing together.
So thank you for that, Thomas. Now let's start by level setting for our listeners. So if you could review historically why there is a cap and income limits and how the cap has been determined in the past.
Yeah. So, Mike, we had a great podcast on this earlier in the year where we dug deep into the history of it. So, I'll go very quickly over it. Uh, in 2010, for various reasons, HUD did away with their old hold harmless policy. And so, because of that, income limits were now able to decrease in any given year. And when they did that, HUD took a look at how they were calculating limits and decided that, hey, maybe it's not good if we have huge swings year from year, either up or down. So, they instituted a floor, but they also at that time instituted a cap. And at that time, the cap was defined as the greater of 5% or two times the change in national median income. And so we've had this cap now for 13, 14 years. So the cap itself is not really new. And so we should all kind of be familiar with this environment of having caps on increases. Now, the notice did change that a little bit, and we'll dig into that during our discussion. But just again, to be clear, this is a cap. So if your income limit, if our cap for this year was 7%, and the underlying data for your area said you should have an increase of 9%, you'd be capped at 7%, right? So the cap impacts you when you're having larger increases than kind of what's happening elsewhere across the board. But if you were anticipating only have a 5% increase and the cap's 9%, the cap is not germane to you at all. And so we're really looking at the upper end of income limit growth, at least historically. And we'll talk a little bit more about maybe some more impact we've seen in the last couple of years on the cap.
Right. Thank you for that, Thomas. I appreciate that level setting. And I will provide a link in today's show notes to the prior podcast, so listeners and viewers can learn more about the history. So with that context, please explain to our listeners what had said in the notice as to how the cap on income limits will be calculated in 2024.
Yeah, so HUD did two things, and we'll talk about uh, everybody's really interested in the 10% cap. So we'll talk about that second to keep your attention. But the first thing that HUD changed is they clarified there's multiple components to the cap. And one of the components is that the cap shall be two times the change in national median income. So they clarified what they mean by national median income. And they clarified that they're going to use the same methodology they used in 2022 and 2023, which is the change in the American Community Survey data, and specifically the most recently published American Community Survey data. So for 2024, it's going to be calculated based on the change in the 2021 to 2022 American Community Survey or ACS data. And so as Mike alluded to earlier, that portion of the calculation results in a cap for 2024 of 14.78%. And so the second thing they did in the notice is they clarified that now there'll be a ceiling on the cap. As I mentioned earlier, there's a floor on the cap. The cap shall never be less than 5%. And now we know the cap shall never be more than 10%. So realistically, we're talking about the cap is always going to be somewhere between 5 and 10%. We now know the upper and lower constraints. And so they implement that 10% ceiling this year. And so we already can see that immediate impact on 2024. We were anticipating that the cap would be 14.78%, and therefore about 10% of areas would be capped. But now that the cap has been lowered or set at the ceiling of 10% for 2024, about a third of the areas will be capped. And so that's what they clarified. Well, they clarified one piece and instituted the second half, which is that 10% ceiling on increases going forward.
And in terms of the clarification you mentioned with respect to how the cap base would be determined, that was obviously very significant and something you, the Income Limits Working Group, and others were reaching out to HUD and saying, please tell us how you're going to determine that. And maybe share with our listeners what it would have been if they had reverted back to a different approach they'd used in earlier years.
Yeah, so HUD has kind of two different approaches that they use. So historically, this is for the most part of the time frame when they've been having the cap, is they used where they took the ACS data and then trended it forward using a CPI trend, very similar or exactly the same as how they calculate income limits for any given year. And they would compare the change in that trended national median income. And that change is what they would double to figure out the cap. And then in 2020, mainly because of data limitations and other things we talked about in other places, they revisited that and said, we don't think we should be using this trended number for determining the cap, and therefore we're going to look straight at the American Community Survey. So if we use the old method, the trended method for this year, the cap would have been 5%. We would have been at that floored amount. And so it was a very, very important question that we had going into income limit. So it's great that HUD has clarified that early for us so that for projects that are kind of in development, we can know now that you can underwrite higher than a 5% increase if that's what the underlying data is telling you.
Thank you for that clarification. I think that's pretty critical. It's one of those questions where it seems pretty arcane, but the fact that you don't know if the cap is going to be 5% or 14.78% or now 10%, it is pretty meaningful in terms of underwriting transactions. So once again, I thank HUD for coming out with that clarification. So now that we've discussed that change, or now we have this a 10% cap, and you mentioned that roughly a third of areas by geography or by number of areas, not by population or weighted any other way,
Right.
would be capped that we expect this year. What's the effect of the announcement on owners or property managers of existing tax credit housing?
Yeah. So I think it's important to separate the distinction between what's the impact of a cap in general and what's the impact of a 10% ceiling on a cap. So some of the stuff we're going to talk about is just present because HUD has a cap, right? But if we're specifically looking at this change of the 10% ceiling, this only comes into place in areas and in years where we have income limit growth that's higher than 10%, which coincidentally enough, 2024 is one of those years. So it will have immediately impact to us. And so again, we're going to have a large number of areas that are capped. And so we're having income and rent growth that is lower than it would otherwise be, but for this 10% cap. And so if I'm a property manager, that's going to do a couple things. Number one is it's going to make it potentially harder to qualify tenants, right? Because our income limits are lower than they would otherwise have been. But tenants are going to enjoy this cap because now they know that my rents won't increase by more than 10% in any given year. But what's interesting about that is I think when we look at what was actually happening in the industry in the last couple of years, when we've had really big increases, 2022, we had a cap of around 12%, and we had increases of 12% in many areas. But we didn't see owners increasing rent by 12% on their tenants, right? They were largely kind of uh, doing this increase over time. But we did see that on vacant units that we were often taking it up to the max that the market would bear as we release up those units. So if I'm a manager, I just have to understand, okay, I'm not going to have increases greater than 10%. I need to understand that's going to that's good news for existing tenants. It's potentially not the best news for new tenants who are looking for housing, and it might make my job a little harder to lease up.
Right. And that's from the perspective that the income level that they have to qualify at will be slightly lower.
Right.
And then in terms of cash flow, the property itself for the vacant units that would otherwise have been released potentially at a higher rent, there's slightly less cash flow for operating expenses and the rest.
Yeah.
Well,
Correct.
So now let's turn to the impact of the notice on the feasibility of properties in a developer's pipeline. I'm sure listeners can begin to think about what you just described on existing properties and the impact it has on the feasibility of properties in a developer's pipeline, but please specify it or be specific as to some of those impacts.
Yeah. So I think that existing projects, again, this isn't a huge impact, right? 10% increase is still pretty good. We probably weren't increasing by more than 10% on existing tenants anyways. But for new projects, it's completely different. It has a much larger impact because number one, we don't have this existing tenant base and we haven't set initial rents at our project. So we'd want to be able to set our initial rents at the max allowed under the program, which for this year would be 14.78% as opposed to 10%. And we'd want to be able to set at that so that we can support more debt and have more projects be feasible. So for these projects coming online becomes very, very important. And if we think about this kind of impact of this, especially if we're thinking about projects at underwriting, it might make a project in an area, a project might be, well, obviously is more feasible at these higher rents than they would be at a lower rent. And so it's going to make some projects not feasible that would otherwise be feasible. So there's going to be less housing supply. It's going to make it so that projects are either going to need more soft financing, more tax credits, or more tax exempt bonds to make it feasible. So what's happening here is, when we have higher rents, we can support more debt. And so we're able to borrow in the open market and ceteris paribus use less other public sources, use less HUD money, use less soft resources from cities and counties, use less tax credits. And so when we reduce this, now we have to reach into that pot more on projects. So that pot's finite, so less projects can get built because of that.
No, I think you said that well when you simplified it by just saying that sort of at the end of the day, for new developments, if the rents are going to be slightly lower, then as a consequence, the permanent financing, the hard debt, if you will be lower. And that has to be made up somewhere else, either through more tax credits or other soft financing. So you end up, in essence, serving slightly lower income level tenants at slightly lower rents, but you don't get as much housing, which in some ways is like the classic, or is the classic challenge that state housing agencies have with respect to the incentive. Is if you want to go really low on income, you can't do as many developments. If you go slightly higher on lower incomes, you can do more developments. And this is just
Right.
a limit on what will be allowed under the HUD income calculations. I think we've talked about the impact this has on tenants. We're basically saying that for existing tenants, there would be this cap on annual rent increases or maximum rents. And that we mentioned, most of the clients aren't, if it was higher than 10%, they wouldn't be rolling it out anyway. But with respect to future tenants, it means, some will qualify because they won't meet the income requirements, but those that do qualify will have slightly lower rents, at least initially. Anything else you want to add in terms of effects on tenants?
Yeah, I think that when we well, a couple of additional thoughts maybe on this in general. Number one is, you know, I'm always hesitant to say it this way, but for the most part, this cap is really just delaying the increases. So the increases will come in future years. Now, there's some situations where you may never get that increase because it declined in future years. You never get to that peak. But for the most part, it's basically just rolling this in over time. And so the tenants will still have this same increase in rent. It'll just happen over a little bit longer period, which for most purposes we're already seeing happen anyways. But I think it's really just the fact that it makes it hard to qualify right away. And I know that people would say, well, that's great. We're assisting people with deeper targeting, and that's a good policy outcome. But I'll say but there's people at the fringes, even when we start looking at an average income project, right? You could have maybe qualified for a 40% household under the higher limits. Now you qualify for a 50% household. So that household, even though they're still getting services, they're paying a higher rent because of this, because they're falling into a different bucket. And then people around the 60% level, because average income's so new, most projects are capped at 60%. People are making just above 60% that would maybe qualify at a 14.78% increase, don't qualify at 10. And so I think that there's pros and cons of this, right, on the policy side,
Right.
and it kind of cuts both ways.
Now, that's the important part from a policy perspective is all these issues do cut a variety of ways. And it's important to be as nuanced as we can about kind of directionally, what the various impacts are
Yeah.
and, let policymakers make the decisions of what they want the policy to be.
Yeah, and while we're on the topic of policy, I think it's important to point out that this is not a codified or codified limit. It's not in Section 42 that now says you cannot have an increase of greater than 10%. And HUD, as we see with a lot of different things to HUD's credit, is they're very responsive to what's happening in the market. And we had a call with HUD this morning, and they talked about how they really look at the data and make sure that their policies aren't harming tenants, and that they're keeping up, that their income limit policies are keeping VLI and actual AMI in line. And so if we did enter this period of rapid inflation, rapid income growth, I think HUD would revisit their policy. And so I think it's good to point out that this is the policy HUD thinks best matches our times today. And as we've seen in the 13 years we've had the cap, they've changed the calculation, depending on how you look at it, 3 different times. And so HUD is going to continue to be responsive to this. And so I think that's kind of the other takeaway that I think is important. We're talking about policy is HUD is trying to implement policy that makes sense and not and it's not locked in stone.
And one of the other items that I thought was interesting, not surprising, but just interesting to have the discussion about it is then that is, HUD is challenged with using old data, 2-year-old data to estimate, what the income and rent limit should be today. And then having to go back and then look every couple of years, you can go back and say, well, how did we do?
Right.
How close were we?
Right.
To actually, getting the numbers for that year and looking at that delta and trying to ensure that that delta is fairly close. It'll never be exactly right. And then making adjustments as you learn from the past. So, and if you go way in the past, for 2008, 2009 and such, there were some pretty big disparities based upon the data that was getting used and how old the data was and how the data was getting inflated and all the rest. So I will say, kudos to HUD over the last 10 years in terms of getting estimates that end up reflecting, when you look back at it in hindsight, a pretty close representation of what it turned out to be when you can look back at it and see. But anyway, enough of that. Let's get back to the topic, which is what are some of the other effects of HUD's clarification of beyond what we've discussed so far, if any?
Yeah, so I think that it's just important to remember that the cap that HUD income limits are not only used for setting, just saying who qualifies for projects and how much rent can be charged. It's used for other metrics as well. And a big one that impacts a lot of us is DDAs and QCTs, or difficult to develop areas and qualified census tracts. So projects located in a DDA or QCT can qualify for a 130% boost in their tax credits, which kind of, keeping it very simple, can result in 30% more equity for the project than they would otherwise qualify for. And so what area is designated as a DDA and QCT becomes very important, especially, so DDAs have a hard cap that 20% of the population is always designated as a DDA. So the impact of income limit caps on DDAs doesn't change the number of areas that qualify or the percentage of population that's covered, but it does change what areas are designated as DDAs. But on qualified census tracts, it actually does change the number of areas that can qualify for qualified census tract, because one of the measurements are more than half of the population have incomes that are less than 60% of area median income. And so when we use a capped area median income, it's harder for 50% to fit underneath that level, right? The higher you take that level to, the more likely it is that 50% will fall under that. And especially when the cap is capping an income limit that otherwise would be higher, but for the cap. And so when we look at it that way, this cap kind of changes the number of areas that qualify for qualified census tracts. So it's not just the cap impacts owners not being able to collect all the rent that they want to collect, right? It's that it does really dictate where projects are feasible, whether it's for the qualified census tract boost, or it's how much debt they can support, or it's how many tenants can qualify to live there. And especially, I think in rural areas, the discussion of the incomes of the income limit and tenants being able to qualify becomes much more important, because you have kind of more, the income bands, I think, are more lumpy in rural areas. So yeah, this does have kind of this multiple ramifications across the industry, and not just in how much rent can be charged at a project.
Thanks for sharing that. And I'm sure some listeners are thinking, as you and I both know, with respect to this 30% boost, if you're in a QCT or developed area, qualified census tract or developed area, if you're going for 9% allocated credits, the state can designate you.
Right.
However, if you're not going for an allocated credit, you tax the private activity bonds to give you the right for 4% credits. There, the state cannot designate you. So it most affects the ability of private activity bond transactions to be financially feasible.
Yeah, which I'd also echo are the ones that are usually supporting more debt and having less soft funds. And so, those projects being able to support more debt is very critical, or having the additional equity.
That's right. So both the direct effect of the income limits has an adverse effect, and the indirect effect, potentially limiting or limiting QCTs, has another indirect adverse effect. So thank you for that, Thomas. Now, I mentioned in the intro that we would talk about some key dates on the horizon that participants in the affordable housing rental community should be paying attention to. Please share some of those key dates.
Yeah, so the big key date is February 8th. That's the date that we have to have comments in on this proposed, it's not really proposed change, but on HUD's change in methodology. And the income limits working group is planning on submitting comments to that. And there's various questions that they ask in there. So I'd recommend that if you're somebody who manages a big portfolio, that you look that over because HUD's really trying to gather some additional information for this. So that's February 8th. And then income limits are supposed to be released on April 1st. So that's when we'll first truly see the impact of this. Now, of course, we've done a lot of estimating and projections and playing with the numbers. And so we kind of have already quantified the impact, but we'll actually see it real life on April 1st when those come out.
Great. Thank you for those two dates. And before I let you go, I do want you to share some other resources that our listeners can look to. In addition to the income limits working group, I will include a link in today's show notes to the income limits working group for those members of our audience that want to join that group.
Yeah, so the first kind of upcoming resources would be, of course, coming to our conference in Florida this week, Thursday and Friday, but also the Affordable Housing Conference in May in San Francisco. The income limits will be out. We'll have a chance to talk about them at that conference. And so, if you're interested in this, that's definitely time to kind of catch me at the conference and pick my brain on income limits because I'll be at that one. And then, of course, the working group that Mike mentioned, the income limits working group, to the extent that we think that there's not a lot of controversy with this, but the LIHTC working group is also discussing if the larger group needs to comment on this as well. But if you're really interested in this impact, obviously reaching out to us and purchasing an estimate for your area so you can understand, am I somebody that's going up by 10%, 5%, or am I one of the 1% of the areas that are decreasing next year? So I think those are all really good resources as you're kind of sitting here and thinking about how does this truly impact me individually? And of course, reach out to me as well. You can email
Yes.
me or give me a call.
No, I do think it's pretty powerful to, look at a given area and get those rent and income limit estimates just to see, am I going to have wind at my back in terms of income limit increases, or is it the opposite? Does it look like things are looking like they might be flat, if you will, in terms of income and rent adjustments over the next couple of years? And as you know, we've had many clients, use those as ways to increase the size of their personal loan commitments and the rest. But I'll let those listeners interested in that reach out to you. So thank you, Thomas. I will include a link to your contact information and obviously the various resources that you mentioned in the show notes for this episode. I will ask you to stay around for our off mic section. I'm going to ask you a couple of off topic questions. And I always like the advice that you can share with our clients and listeners. And to our audience, please do take a moment. I say this every week, so I just encourage you again. Please subscribe to Tax Credit Tuesday on your favorite podcast platforms to make sure you don't miss an episode. I also encourage you to review the episode on your platform. It helps other listeners find the show, or other viewers find us on YouTube. And if you have any questions or ideas that we should discuss in future episodes, please email us at cpas@novogradac.com. Okay, now we've reached our off mic section. And I have two fun questions for you. First, we at Novogradac have lots of employees starting this week. What advice, Thomas, would you give somebody, or are you giving some of your new employees that are starting their career?
Yeah, so actually was going to answer this differently. Then when you asked me, a different thought came into mind. And this is something I shared with my group of new hires that we met with on Tuesday. And I think it's important to understand when you're joining a new company, everybody there, hopefully everyone there, at least a Novogradac company, everyone there wants you to be successful. And I can't be successful unless you're successful, right? If my interns are not successful and I'm not training them how to do the work, then the work's never going to flow to me and we're never going to get it done. And so you have this whole network of resources behind you that's rooting for you to be successful. And so don't be afraid to kind of tap into that and ask questions and try and lean on the knowledge of those who've been there before you, because they want you to be successful. They want you to learn all this because ultimately I'm more successful the more successful you are. And your manager's more successful the more successful you are. And even your fellow interns, as you're learning knowledge and you're sharing with each other, you're all going to be kind of more successful. And so I think the key is just remember that there's a lot of people in your corner that are rooting for you to be successful, and tap into that because they want you to succeed. And that's why they brought you in.
Right. That's super advice. Thank you for that. Following up maybe on that question about, ways to advance your career and the rest. One of the beauties that I like about the areas where we practice is there are constant changes. So I can really lean into that, but also it can be challenging. What's one or two of your best tips for adjusting to changes in your career or changes in your profession, changes in your practice area?
Yeah. So I think you hit it on the head when you said we work in a kind of what can be not a volatile industry, but we often get HUD notice on a Wednesday that changes how we look at things. And I think for me, it's really kind of embracing that. I once had a manager who we ran into this technical issue, and I was like, oh yeah, we need to do some research on this and write a memo. And she was like, oh, I hate research. I just thought, you're getting paid to improve your knowledge, improve your skills, and write a memo on that. That seems like awesome to me. If somebody wants to invest that kind of money and time into me to learn a new topic and be able to become an expert in it. So I think it's just embracing that and looking forward to that challenge and change and being willing to put in that time and effort to become an expert in it. Because usually, I think I've said this before on the podcast, usually new guidance can be such a level setter. So you can be kind of the first mover advantage where you get this new guidance. Nobody knows anything more about it than you do. And so you can jump into that and become an expert in it and really help that as kind of a springboard for your career. Or what I do is when I do that, then I can use it to really help benefit my clients, because I can say, hey, clients, we're the first to understand this. Let's figure out how to do this. Let's figure out how to qualify for these ITC adders. Let's figure out how to benefit from these new funds that are available. And so I just look at it as although it's a change, typically that change comes with an opportunity. And so if you look at it that way, I think it helps you be better prepared to embrace that change and figure it out and want to dive into it.
Well, I really like the framing of change as opportunity. I can relate to that, but that's a nice short way of looking at that and saying it, change is opportunity, and viewing it that way certainly helps you embrace change. So thank you, Thomas. I appreciate you joining me on the podcast. I appreciate you rearranging your schedule to deal with our breaking news item. I don't know what HUD notice on Wednesday you were referring to, but
yeah, right.
And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.